So we were on question number 6. 6 or 5? 6, right? We are on 5? 5 was done. So we are on 6. Good morning, by the way. Question number 6. Risk and return on portfolio. An investor holds 2 equity shares of X and Y in equal proportion with the following risk and return characteristics. Expected return on X, standard deviation of X. Expected return on Y, standard deviation of Y. The returns of these securities have a positive correlation of 0.8. You are required to calculate portfolio return and risk. Further, suppose that investor wants to reduce the portfolio beta to 15%. How much should be the correlation coefficient to bring the portfolio risk to the desired level? This is not beta, this is standard deviation. To 15%, how much should be the correlation coefficient to bring the portfolio risk to the desired level? Clear? So how will we solve this? Yes, we will simply use a formula, calculate the risk of the portfolio, then return, which with return is calculated as, how do you calculate portfolio return? Do you have a closing price, opening price? वो मतलब स्कूल के बच्चे से 2 का टेबल बना तो शुरू हो गया. How? See here. Do you have expected return on X, expected return on Y? Do you have weight of X, weight of Y? Then how will you calculate? By taking a weighted average. Okay. See here. When you want to calculate expected return, simply calculate a weighted average. Okay, how do you calculate a weighted average? Weight of X into return on X plus weight of Y into return of Y. This is called as the expected return. And how do you calculate standard deviation of the portfolio? Weight 1 square, standard deviation square, weight 2 square, standard deviation square, 2 into weight 1, weight 2, standard deviation 1, standard deviation 2, correlation coefficient. Okay, so quickly solve for this. So you can say that expected return of the portfolio can be calculated, point A, expected return of the portfolio can be calculated by taking a weighted average, of constituent securities. Again, below that you can say expected return is equal to this formula. Weight of X into return of X plus weight of Y into return of Y. Weight of X into return of X plus weight of Y into return of Y. So let's see what are those returns. X 26% and weight of X is equal proportion, so that is 50%. So 26 into 0.5 and 20 into 0.5. How much is the answer? %23. Half of 26, which would be 13, and half of 20, which would be 10. A total of 2 is 23%. Then let's say below that the portfolio standard deviation can be calculated using following formula. Portfolio standard deviation can be calculated using following formula. So you can say standard deviation of portfolio P is equal to under root write down the formula for it. weight of x into standard deviation of x square plus weight of y standard deviation of y square plus 2 into weight of x standard deviation of x weight of y standard deviation of y into correlation coefficient. Now when you solve for this, just make sure that you write down these terms individually because we would be needing them later on. So write down how much is weight x standard deviation x and then say that number square, weight y standard deviation y, that number square. Yeah. 28% and 23%. 28% for x and 23% for y. Twenty. How much, Angelica? 22. Okay. Let's do it together. You can say memory recall, clear of your memory. Then say 14 into 14. 14 into 14, m plus 11.5 into 11.5, m plus 1.6 into 14 into 11. 1.6 into 14 into 11, m plus. Memory recall under root. How much? 24.20. आपका कुछ और आया? हाँ? Are we good to move on? Now the second part of the question. The returns of these securities, further, suppose that the investor wants to reduce the portfolio standard deviation to 15%. How much should be the correlation coefficient to bring the portfolio risk to the desired level? Okay, so what we have do here input the standard deviation as the input and find out for R, which means now the answer would be that we know 15 is equal to weight 1 standard deviation 1, this was 14 square, plus this was 11.5 square, plus this is 1, okay, so this would be 2 into 14 into 11.5 into R, and then solve for this equation and find out what should be the value of R. Just a minute, I'm solving for it. Yes, correct. Minus 0.32. So if your correlation coefficient is minus 0.32, then portfolio standard deviation will be 15%. Have we done? Great, so you're doing good. Next question. Question number 6. Capital market line. Do you remember it? Oh, again the numbers have gone wrong. Question number 7, which would make this as 8. Okay, so question number 7. From the following information, ascertain the market price of risk of the portfolio from the following information. Market return is given, standard deviation of market return is given, risk-free rate is given, standard deviation of the portfolio is given. From the following information, ascertain the market price of the risk of the portfolio from the given information. Second, also determine the expected return for each of the above cases. Yes, what would be market price of the risk? That for 1 unit of risk, how much extra return are markets giving? That would be market price of the risk. And what is that? Yes, RM minus RFR. फॉर्मूला अच्छे से याद हो जाता है नहीं? RM minus RFR. No, that is CAPM. Okay. See, number 1, the difference between CML and SML. What all lines did we study? We had studied CAL, capital allocation line, capital market line, and then security market line. Capital allocation line and capital market line use standard deviation. Security market line use beta. Now, CAL is when we have a individual portfolio. CML use when we have a market portfolio. So expected return on a particular stock is equal to RFR plus Sharpe ratio of market multiplied with standard deviation of the portfolio. And how do you calculate Sharpe ratio of market? return on market minus RFR divided by sigma M, or standard deviation of M. Okay, so what is the intuition here? That let's look at this example. Markets have earned return of 18%. Okay, RFR is how much? 6. So how much extra returns did market earn? 18 minus 6, 12%. Now to earn 12% return, how much risk have we taken here? 6. So how much is the extra return you've earned per unit of risk? 12 divided by 6, 2. Isn't it? So we will say that this is the market price of risk. So market price of risk is nothing but the Sharpe ratio of that portfolio. Are we clear? So let's plot this. We will try to solve this in the table format itself. Okay, so let's do it in this fashion. First column, market return. Second column would be standard deviation of market. We are going to need more number of columns, so save some space. Or wait for me to finish. RFR, standard deviation of the portfolio. Then here we will say market price of risk. Market price of risk. Then after which we will say expected return on the portfolio. Okay, expected return on portfolio. And how will we calculate expected return on portfolio? So we will say expected return is equal to RFR plus market price of risk multiplied with standard deviation of the portfolio P. So let's call this as A. In fact, hold on a minute. Let's call this number as A. Let's call this number as B. And here this number would be C. Expected return on portfolio is going to be A plus B multiplied with C. Okay, so let's start plotting values. Market return here 18%. So typically here I'm writing in percentage. You people can write 18% in the respective column. Then 20. Then 22. Okay. Standard deviation of the market 6, 8 and 9. Risk-free rate of return 6, 7, 8. Standard deviation of the portfolio 8, 6 and 10. Market price of the risk. So market price of risk here we will calculate by saying return on market minus RFR divided by standard deviation of market. Okay, so let's say return on market 18 minus RFR 6 divided by standard deviation of market 6 to 1.625 and 1.56. Once you have this, then we will use the CML model. RFR plus market price of risk into standard deviation of the portfolio. So is equal to risk-free rate of return plus market price of the risk multiplied with standard deviation. Have you understood how it is done? Is it done? Are we good to move on? Any question, any doubt, anything not clear, please ask. Which one? This one. A plus B into C. RFR plus market price of the risk multiplied with standard deviation of the portfolio. And market price of the risk is nothing but the Sharpe ratio. Okay, let's move on. Next question. Question number 8. Is it not clear yet? You want to ask anything? See, it's 8 into 2 plus 6, 22. 6 into 1.625 plus 7. Alright, next question. Question number 8. X Company Limited invested in 1/4/2005 in certain equity shares as follows. So we have M Limited and L Limited. 1000 of rupees 100 each, 500 of rupees 10 each. The price at which we have purchased is given to us. In September 2005, 10% dividend was paid out by M Limited. In October 2005, this must have been 30% dividend was paid out by L Limited. On 31/3/2006, market quotation showed a value of 220 and 290 per share for M and N respectively. On 1/4/2006, investment advisors indicate that dividend from M and N for the year ended are likely to be 20% and 35% respectively. B, that probabilities of market quotations are as follows. Okay, so what does it say? Calculate average return for the year ended 31/3/2006, expected return for 2006-2007, and advise X Company Limited of the comparative risk in two investments by calculating standard deviation in each case using probability table corresponding to the value provided above. That means using these tables we want to calculate the standard deviation of M and standard deviation of N. Okay, now can you solve the first part of this question? Average return of the portfolio for ended 31/3/2006. Yes, you remember the formula. How do we solve for it? How will we solve? You know the formula. What is the formula? अभी बोला ना थोड़ी देर पहले, कैसे निकालते हैं? क्या? Closing price minus opening price divided by opening price. Same logic here. See, 1/4/2005 में आपने खरीदा, and then in the same year it is given some dividend, and then at the end of the year the stock price is increased. So it's straightforward. Okay, you would first say opening price, closing price, dividend received, and then percentage return. Okay, so I'm going to make that table for you here. Okay, I'll just make the format. You can give, say, part 1 of the question, and say calculation of actual returns for the year ended 31/3/2006. This is the heading. So here, name of the security. Then we will say acquisition cost. Second, closing price. Dividend received. So we have dividend received here, and then percentage in actual returns. Okay, so below each you will have to write down the explanation. Acquisition cost would be total cost divided by number of shares. Total cost divided by number of shares. Then closing price is given to us. Dividend received. Do we calculate dividend as a percentage to face value or market value? Always the face value. So we will say face value into dividend rate. And then how will you calculate actual return? So we'll say closing price minus opening price, closing minus opening plus dividend. Okay, and this whole number divided by opening price. Closing price minus opening price plus dividend divided by opening price. Okay, so that you don't have to rewrite the formula again and again. So let's solve for this. M and N. Or do you want to try this? Try doing it on your own. जैसे 100 रुपए का स्टॉक है आपका, it becomes 120 plus it gives you a dividend of 5. So total benefit 20 plus 5. Yeah, just are you done with this? Yes, is it done? Do you need any more data? Done? Yes, are our answers matching? Okay. Second part of the question now. On 1/4/2006, investment advisors indicate that dividend from M and N for the year ended are likely to be 20% and 35%. And the probabilities of market quotations as follows. Okay, so we have a probability factor, we have a share price. Now, you are required to calculate average return from the portfolio for the year ended 2006-2007. So again, you can say part B, calculation of expected return for the year ended 2006-07. Part B, calculation of expected return for the year ended 2006-2007. Okay, so the logic would be same. Name of the security. Here we will say opening price. Okay. Then we will say expected closing price. So this is my opening price here. Name of the security, expected closing price. And below expected closing price, you would write down a formula. You would say P into S1 plus P2 into S2 plus P3 into S3. Okay, so what we are going to do is simply calculate a weighted average. Probability into stock 1, probability into stock 2, probability into stock 3. Then same, dividend would be face value into dividend rate, and then we will calculate the actual returns. Okay, so solve for this quickly now. Name, Opening price same, exactly same format. Expected closing price, dividend received and actual return. Should I show the question? You can see the question now. Are you getting the same? Okay. Let us solve for second one as well. Our values should match. Are the same? What's wrong? 312. Okay, यहाँ तक. For dividend received, this should be simple. This should be 20 and this should be 3.5. Yes, is it same? Any is getting different answers? No, Neha? Do you have opening price is 220? It's different? What was the closing price last year? 220 and 290. Now we are in which year? 2006-7. So the closing price of last year is the opening price of this year. It should be 220 and 290. Please increase your speed. This was the easier part of the question. The most interesting part is the last part. Are you done with this, Angelica? Neha? So now the last part here. Advise X company limited of the comparative risk in the two investments by calculating the standard deviation in each case using probability table corresponding to the value provided is above. Okay, so you have to advise X company of the comparative risk of two investments, investment in M and investment in N. By how? By calculating standard deviation. So if you have this probability table, can you calculate standard deviation? Tell me the formula for standard deviation. How do we calculate standard deviation? Summation of x minus x bar square divided by n under root, and this is the standard deviation of course population. If I want to calculate standard deviation of sample, x minus x bar square divided by n minus 1. The formula that you people probably remember is this: x minus x bar into y minus y bar divided by n. What is this formula for? If there were two variables, this formula would have been for covariance. And once I calculate covariance, then I divide covariance with standard deviation of x and standard deviation of y, then I get correlation. We don't need this here. What we need is just this: x minus x bar square divided by n. But this divided by n we use when the probability score is same for each one of them. Now the probability scores are different, so now we'll have a improvised version of the same formula, summation of x minus x bar square multiplied with probability. Okay, so when you divide by n, what it basically means is every number was multiplied with 1 by n, isn't it? But now the probability score is different, so we'll multiply every number with different probability. So write down below: calculation of standard deviation of share M and N limited. The third part of the question. So let me do it on a separate spreadsheet. Calculation of standard deviation. First we will say probability here. Then we will say expected value of M limited. Expected value of M limited. Then here we will say x minus x, so we can say M minus M. While writing, you people draw a bar there saying that you want to reduce the mean. M minus M bar, and here we will have N minus N bar. Once you have that, then you will say P multiplied with M minus M bar and P multiplied with N minus N bar here. Okay, so let's first write down the probability: 0.2, 0.5, 0.3. 0.2, 0.5, 0.3. Then expected value of M: 220, 250, 280. So below this we will solve for M bar. We'll say mean values is equal to in fact, let me do it directly. Sum product. It would come out to be 253. And then mean of this value. So let me plot the values here: 290, 310 and 330. So 290, 310 and 330 is 312. Okay, so we have mean of 253, mean of N limited, which is 312. Is it same as the earlier one that we calculated? Okay. Then once you have this, then we will calculate M minus M bar, which would be equal to 220 minus 253, and then minus 33. Then on this side we will have n minus n bar. Then probability multiplied with m, probability multiplied with n, and then we take a total of this. So here you have to say square. So 33 raised to 2 multiplied with probability, and this side we will say 22 raised to 2 multiplied with probability, and then we will take a square of these, total of these here, and then we will say standard deviation is equal to 21 and 14. So 33 raised to 2 multiplied with 0.2. Are we done here? If you have any question, please ask. Should we move on? Next question. So this should be question number now 9. We've solved 8, right? So this is 9 now. Covariance and correlation coefficient, March 2007. The historical rates of return of two securities over the past 10 years are given here. Calculate the covariance and correlation coefficient of the two securities. Yes, will you be able to calculate this? And it's an actual exam question. So if you know how to do it smartly, it will save you huge time. But if you try to solve for them separately, it will take a lot of time. For example, what we need for covariance, x minus x bar, y minus y bar. So we will first calculate for x minus x bar, y minus y bar. Now what we need for correlation is covariance and the two standard deviation. So immediately itself we will make a column for x minus x bar square, y minus y bar square, x minus x bar, y minus y bar. We will make all the columns and then using them we will solve for it. Followed? So let me make the format for you. You try solving this on your own. We will say year here, then security 1, let's call this as X, security 2, let's call this as Y. then this is where we will say x minus x bar, then y minus y bar, then x minus x bar square, y minus y bar square, x minus x bar, y minus y bar. Now x minus x bar multiplied with y minus y bar. So these are the number of columns that we need. Here security 1, security 2, x minus x bar, y minus y bar, x minus x bar square, y minus y bar square, x minus x bar, y minus y bar. 1 to 10. 12, 8, 7, 14. 12, 8, 7, 14, 16, 15, 18, 20. 16, 22. 20, 22, 24, 18. 15, 20, 24, 25. Just a minute, let me finish, we'll cross check it again. 22 and 20. हाँ बोलो. 14, 16, फिर 15, 18, 20, right, 16, 22, 20, 22, 24, 18, 15, 20, 24, 25, 22, 20. Yes, done. Start solving now. Just make sure your means are same so that it saves a lot of time. The examiner must have been vicious to put this question. Correlation is covariance divided by standard deviation of x multiplied with standard deviation of y. Covariance divided by two standard deviations. Yes, Neha, anything wrong? Most of the calculator used for finance purpose these days, they solve these values ready-made. You just input the data into calculator, it gives you the answer. Are we good to move? Are you done with this? Any problem? Question number 10. Covariance and expected return March 06. Let me just bring it on the bottom page. The distribution of security F and the market portfolio P is given below. Calculate the expected return on security F on market portfolio P and covariance between the market portfolio P and security and beta for the security. Can you solve for this? A question just to check whether you can remember the formula. Expected return निकाल सकते हैं? How will we calculate expected return? Weighted average, yes. 30 into 0.3. You can do it orally. This should be how much? 3. This should be 9. This should be 8, 17. So for F it is going to be 17. This is minus 3. This is 8. So 5. 5 plus 9, 14. So for security P it is going to be 14%. So we have calculated market expected return. Now how will you calculate covariance? The same logic. First you will calculate x minus x bar, y minus y bar. Now we don't have so we don't say divided by n. Why? Because we have probability score, so we will simply say multiplied with probability. So summation of probability x minus x bar, y minus y bar, and that will give you the covariance directly. Then in this fashion you will calculate covariance, and then how will you calculate beta of the security? Covariance divided by variance. Covariance between security A and market divided by variance of market. So using this formula you will calculate beta, and done. That's it. करो या मैं करूँ? Okay, I'll make the format for you. You just plug in the figures there. Probability is the first. Then we will say returns here on F. Okay. Then returns on portfolio P. So I'm going to simply call this as F and P so that it will save space. Returns on security F, returns on security P. Then here we will say F minus F bar. Here we will say P minus P bar. So when you write that, you make sure you make that bar at the top. Don't write bar. Okay, so F, come on. F minus F bar, P minus P bar. Then we will say we want to calculate variance. So variance of the market, which is P minus P bar square. Okay, this will help us calculate variance of P. And then here we will calculate P multiplied with F minus F bar multiplied with P minus P bar. And then this last column will help us calculate covariance. Okay, so let's plot the values. 0.3, 0.4, 0.3. Then F 30, 20, 0. P minus 10, 20, 30. And then first you calculate F bar here. So you would say weighted means. You put the formula. I'm doing it ready-made. The answer should be 17 and 14. Okay, so how will you expand? How will you solve this? You will say 0.3 multiplied with 30 plus 0.4 multiplied with 20 plus 0.3 multiplied with 0. And in the same fashion solve for the other one. Are we done up to this? Then start solving this. F minus F bar, P minus P bar, P minus P bar square. Are you done up to this? Okay, Niranjan. Then below that you just have to write down the formula. So we have calculated expected return on security F 17, then expected return on market portfolio P 14. We've done that. Then covariance. So covariance between the two securities is this. So you can just write down the solutions here. You can say expected return on portfolio F, expected return on portfolio P. So this is 17, this is 15. Then covariance is minus 168. And then you will say beta. So for beta, write down the formula: covariance divided by variance of market. Okay. Covariance divided by variance of market. So the answer would be covariance, which is minus 168, divided by variance of the market, which is 868. So beta of the security is minus 0.19. Done? Are we good to move? Yes, no? Any question? So let's make again a summary of all the formulas that you need at one place. So what you do is you try to remember these formulas this week. Okay. See, these are easy marks. If a question comes, it is only testing your ability to remember formula. There's nothing else in this. So ability to remember formula and solve the question quickly. Okay, so remember these formulas. What formulas do you need? First, you need the formula of simple mean. Simple mean is summation of x divided by n. Then you need weighted mean. Weighted mean would be P1 into S1 plus P2 into S2 plus P3 into S3 plus Pn into Sn. This will give you a weighted average mean. Then third thing, you need standard deviation of population, okay, which is summation of x minus x bar square divided by n under root. Fourth formula, standard deviation of sample, which would be summation of x minus x bar square divided by n minus 1. Then fifth formula, which I am going to mark as important, standard deviation with weights. So when we have weights, we simply say P into x minus x bar square summation, and then the whole thing under root. We don't have to divide by n now because we multiplied with probability. Then the sixth formula is coefficient of variation, which is simply standard deviation divided by mean. Seventh formula is of covariance. So covariance would be x minus x bar y minus y bar divided by n. Eighth formula, again I am marking this important, covariance with probability. So when we have covariance with probability, we will say P into x minus x bar y minus y bar. That's it. We don't have to divide by n. Then eighth formula is going to be correlation, which is simply covariance divided by variance of market. So covariance between security P and M divided by variance of market. And then ninth formula, which is again correlation, is equal to sorry, I made a mistake here. This is beta. This was the formula for beta, which is covariance divided by variance. And then ninth formula, which is for correlation, which is covariance divided by standard deviation of A into standard deviation of B. Just a minute. Are you people done writing this? Let them finish. Okay, so what you can do is probably make a chart out of this, put this on your wall for a few days, so that automatically you would remember them. Are you using 60-minute guide to derivative? The poster I had given you. It's decorating your wall. हो गया लिख के? हाँ, कौन सा क्वेश्चन? 7th. Yes, tell me. Hmm. Mm-hmm. Mm-hmm. Correct. Yes. A प्लस एक ही बात हो गया ना. A plus B into C and A plus Bodmer's rule. You multiply first, then you add. A plus B into C, isn't that same as A plus C into B? What do we do first? See, is this your... I get your point. What you're saying is A plus, the formula says Sharpe ratio multiplied with standard deviation of portfolio. So it should say A plus C into B, isn't it? But whether I put this for, instead of E, if I put D here, and if I put E here, the answer will still be same. It's simple BODMAS, right? In any equation, you first multiply, and then once multiplication is done, then you add. See, okay, it's like this. I'm telling you, I'll tell you what you're doing here. You're adding A plus B, and then you're multiplying that with C, isn't it? It doesn't happen that way. See, any mathematical equation, if there are no brackets, okay, so it says A plus B into C. If this is the equation, then what do you solve first? You first solve for multiplication. Okay, so BODMAS. B is for bracket. O किसके लिए होता है? Operations. So O stands for operations. Then D is division. M is multiplication. Then addition and then subtraction. So which means if the equation is like this, first you have to solve for this and then you have to solve for this. Okay, even if there are no brackets. मेरे वक्त वो था कंचे भागू बेबो कौंस मका चे हाँ चे क्या था कंचे yeah I don't remember. चे must be this operations, right? Chain. चे मराठी में नहीं होगा ना, बट ऑपरेशंस का मराठी में वर्ड होगा चे. कंचे भागू बेबो. Is it done? Okay, so great. Let's stop for the day.